How to trade fair value gaps. So let's start with what is a fair value gap. So basically, a fair value gap is the imbalance created when a big market mover like banks or institutions moves price up or down so fast that it creates a little gap in the market, just like so. And it leaves a lot of untapped orders that needs to be filled in this area. So now we mark the top of the first candle wick here, just like so, to the third candle bottom wick, just like so. And this is our imbalance created. So here I have prepared a market move that is perfect, a perfect example for what we were talking about. A fair value gap, a different confluence, a perfect entry, and a perfect exit. So let's start with finding our fair value gap. So as we can see, the market is insanely bearish and created a fair value gap. So now let's mark out the fair value gap. We can't just enter off this fair value gap as soon as it's retapped and then put a stop loss at the top and a previous low. As you can see, you're going to end up being stopped out. So now let's add another confluence with a fair value gap to enter the market perfectly. So now we know that we have a fair value gap here. And now we're going to use something else called an order block, which is the entire wick before the fair value gap was created. So we're going to mark it just like so. Top of the wick, bottom of the wick of the last candle before the fair value gap. As you can see, while the fair value gap was being filled, the order block has been tapped. Now that's where we enter our market. Here, we can enter shorts, stop loss above the order block, and a TP below past liquidity right here. And let's watch this trade play out. Very nice rejection off the zone. And boom, straight to TP. And that's how you use fair value gaps to trade, everybody.